Hello, everyone. Welcome, welcome, welcome. We're so happy to have all of you here. We hope you will get a lot out of what Joe is going to present today because education is so important. And I wanted to read this, and I'm going to this. I like to find a quote that fits with what the person's going to speak about. And this is what Joe's going to speak about today. Abundance isn't just stuff, it's beauty, joy, and love. There's true definition of science in this study of the beauty of the world. And that is what abundance brings to us. So I'd like to introduce to you Joe Fulvio, serves as a CAMA plan liaison to private equity, private lending, and venture capital organizations, where he simplifies the IRA 401K investing for these companies and their investors. Before this, he spent 4 decades working with startup ventures and growth company entrepreneurs and investors in a broad range of industries, in the United States, in Europe, and in Asia, delivering measurable improvements in revenue growth, profitability, and shareholder value. He now applies these market development strategies to businesses operating and their experience to evaluating investment opportunities. As an enthusiastic advocate of self-directed IRAs and 401Ks, he brings an everyday investor's perspective to using these tools to build a portfolio and account and accumulate wealth. Yes, we like that. He's a graduate of St. Louis University, lives in Bucks County, Pennsylvania, and has been a CAMA plan client since 2015. And you need to wait for Vanessa to get on because she's young, 20, and she doesn't
Yes,
know
it
yet,
is.
but where she should be is investing with CAMA plan.
Absolutely.
So
Roth
Vanessa,
IRA.
welcome. We're glad you're here, and we want you to pay attention to what Joe has to say about CAMA plan because the time value of money is so important, and most people don't get it. They think if they save later, they'll be able to do a better job. Saving now is the time to start. So
Abs
Joe, take it away. Thanks.
Thank you so much, Peggy. What a nice introduction. I don't know who wrote that, but I'm what happens if you don't have a career plan, and I think somebody cleaned that up quite nicely for me. So I'm going to share screen. I'm available to talk to children who are maybe heading down the wrong path at any time. So let me just see if I've got
Oh,
the right
Vanessa's
one.
not, Vanessa's heading down the right path. She's with someone that teaches her about how investments work, and she's going to school and learning, and she's on the right path. And she's also signed up to do our investment risk advisor mastermind. So she's
Wonderful.
totally on the right path. So
All right. Good, good.
keep
Well,
leading her that way.
let me know if you can you see the screen or am I
Yes,
seeing? Okay, so you see it with the Nest Egg Builder logo and all the good stuff on there.
yes, thank you.
All right, there we are. All right, so we're going to talk about turbocharging investment returns, and I want to thank everybody for showing up. It's the end of the day. Everybody's maybe looking to go to the gym or go home and have dinner, but thanks for spending a little bit of time with me. Hopefully, I'll make that worthwhile. Um, I'm going to try to scroll through this. Let me see if I've got this thing right. There's always a technical. Here we go. I think if I click on that, first, I've got to do the heretofores and notwithstandings, the disclaimers, the lawyers have to earn their keep. So we don't provide investment advice. We're just experts on using IRAs and 401Ks to invest. So, any information, you receive from me is supplemental. It's intended for educational purposes. And, we always tell you to go visit with your CPA, your tax advisor, your lawyers. Get yourself a team of experts to help you with this. Don't do it alone. And of course, be part of the Nest Egg Builder community because you'll learn from people who've learned a lot and have made a lot of mistakes that you'll want to avoid. So, we're kind of like we're the custodians. We're sort of a neutral third party in any of these transactions. We're kind of like in the old Westerns, the piano players. Don't shoot us, we're the piano players. But we'll give you all the help we can. All right. So, first, a little bit about us. We've been around for 20 years. I had our anniversary in August of this year. We're headquartered in Ambler, Pennsylvania, which is in the suburbs of Philadelphia. So everybody's still celebrating a Super Bowl victory. They'll probably continue to celebrate it most of the year. We serve about 8,500 clients nationwide. We have more than $1 billion in assets under management. And we like to think we have a good reputation for service. And there's probably about 40 companies in this business, in this space of self-directed custodial services. And probably about 25 of them matter in terms of being very active. And we're kind of right in the middle in terms of size. So we like to think we can get anything done that you need done, but we're small enough to answer the phone. So, if you were calling in to set up an IRA or 401k, you talk to me or Courtney or Will, and those people are available. I'm available for you to talk to. So, what do? I spend, as Peggy mentioned, I spend most of my time dealing with private equity, venture capital, and private lending organizations and making this whole process of connecting them with investors easy for them and for their investors. So we're big on education. That's why I'm here tonight. We have a lot of podcasts and webinars and research materials at our resource materials at our website. So feel free to go there and check all that out. I'm going to share some of that with you towards the end of this presentation. So let me see if I've got the next slide. A bit about the founders. You may wonder where the name CAMA Plan came from. That's Carl Fisher and Maggie Polisano, CAMA. They are brother and sister. Carl is the oldest of 12, and Maggie's somewhere towards the last three, I think. And Carl is actually was a rocket scientist. He worked for NASA on the shuttle program. And so he has a very clear engineering focus when it comes to these things. And Maggie comes from a background in Fortune 100 IT and building applications and platforms there. But the really interesting thing is that they are a third generation real estate family. So they've been at this stuff for a really long time. And when they discovered that you could do this kind of thing, that you could use IRAs and 401ks, they set up this company, as they say, by investors for investors. So this was really set up for you. I'm an investor. Most of the people who work here are investors and have accounts here. So we really look at things from your perspective. So enough about us. Let's get on to what we're going to talk about tonight. One more thing. What do? We're just the third party. As I said, we keep records of transactions. We keep you clean with the IRS. We publish the tax documents or print them and send them to you so you can share with your accountant or your tax specialist. And we also provide them to the IRA or IRS. Just consider us a member of the team. We spend a lot of time on the phone with people's advisors and their tax prep specialists to explain things to them. So we're just another member of your team. Tonight, we're going to talk about a couple of things. First, understanding what true self-direction is. There's a lot of use of that term, and it's kind of like a rubber band. It's stretched around a lot. So we're going to talk about what they are and what they're not, and then different types of investments you can do. And you're going to be kind of surprised that there's very few things that are prohibited when it comes to IRA investments. We're going to do an example of an investment inside and outside of an IRA to give you an idea what the tax savings and the benefits are. We find when we do analyses of various offerings that you can increase the size of your return by 25 to 30% by using the tax deferral and tax-free aspects of these types of accounts. And we're going to talk about how it actually works. How would you get started? What are the steps? Because we want to kind of demystify it. A lot of people think it's confusing, and from the outside, it kind of looks that way. But we're here to help with that stuff. So we'll get you through that. And then I've got a whole bunch of resources that I want to share with you. Some downloadables, some QR code stuff that will help you get familiar with this sort of investing and make you more comfortable. Um, Feel free to interrupt with questions, by the way. I like conversation, and the more I hear myself droning on, I'm liable to put myself to sleep. I know I do it with my wife puts her to sleep. So interrupt me with questions. If I can't answer the question, I'll get an answer for you. Carl is probably one of the 3 or 4 most knowledgeable people in the country on this, and we have access to a whole lot of subject matter experts when it comes to various aspects of investing in a 401k or an IRA. All right, first thing let's clear up is what is a self-directed IRA. Now, Schwab and Fidelity are set up to trade um, listed securities. That's stocks, bonds, and mutual funds. And they will tell you, and there's some degree of truth in this, that it is self-directed in the sense that you pick and choose what stocks and bonds and mutual funds you want to invest in. But true self-direction goes beyond what's available at Wall Street. Now, I have a brokerage account at Fidelity. I love my brokerage account at Fidelity. I do business at Fidelity. They're great places, but they're set up to handle certain types of assets. They have seats at the exchanges. I know when I go home at night, if I feel like I want to place a sell order, I can do it before I go to sleep and it will clear the next day. Over here on our side, we handle alternative assets like apartment buildings and business ventures, vacation rentals, and things like that. Assets that are a little bit more clumsy. They're not bought and sold on any exchanges. They're sometimes difficult to value. That's our world, and that's the world we like to live in. So some financial institutions will claim this, but it's not um, true self-direction. Go up here, the next slide. One of the advantages of doing this kind of investing is that we think it gives you more control and you can invest in what you understand. If you're a real estate agent or you're a contractor or you've had experience in any industry, you already know a lot and enough to invest within those industries or within those markets. So we get a lot of people who are real estate agents or who are contractors who've done fixes and flips for some people and have figured out the math, or who have been accountants and have seen the financials involved with various business ventures, and they see how they can do this themselves, and so they come to it with a unique perspective. Um, if you've got an area of expertise, like we have a lot of people who retire from particular industries, and they're in a catbird seat to know exactly, what new technologies and new companies and new initiatives are going to shape that industry going into the future. And so they come out and they look for opportunities to invest, and they use their self-directed IRAs to invest with those sorts of companies and in intellectual property and that sort of thing. So from wherever you are, you understand things about what you've done for a living your entire life and the experiences you had. Even I can't remember Peter's last name, but he headed up the
Deals.
no. This was the director of the Magellan Fund,
Oh, Lynch.
Peter Lynch. Thank you. Yeah, he said invest in what you know, invest in what you think, in what you know and what you like. So you all have a unique perspective based on your experiences, and this is a great way to use it. Now, there are many different types of IRA and 401k plans, but they fall into two very broad categories. They're tax deferred and tax free. Most of you are probably familiar with a traditional IRA.
And most of them are familiar with Ross also.
With Roths, yeah, on the other side, on the tax-free side, and the spousal IRA is something that happens when one spouse passes. For small companies, the SEP and the simple IRA are excellent vehicles to put a retirement type plan on top of a small company you have. Those of you with side gigs might consider that. Um, the defined benefits plan is what we used to call a pension. They're kind of rare these days, and they've been replaced by the defined contribution plan, which is the 401k. Now, the thing about the tax deferred is that you're receiving an incentive, a deduction for contributing to these kind of plans. They're pre-tax. We like to liken it to the government subsidizing the seed that you're going to plant in the ground. And at the end of the day, when you start moving that money out of that account, their government is going to want to share in the profits or in the crop that's grown with those seeds. So that's what tax deferral means. And the thinking behind that was that, well, when we retire, we'll be in a lower tax bracket, and so it won't be so painful. I'm going to continue to work for many, many years to come. So I don't see that happening for me. So that's what makes the Roth side much more attractive. And we're big proponents of the Roth. And the Roth, you don't get any incentive for putting anything in. You put in after tax dollars. But because you paid for the seed, you get to keep the whole crop. And there are some other aspects about these types of plans that are more favorable than the traditional or tax deferred IRAs. Tax deferred
I asked
IRA.
you a question,
Yeah,
if
fire
I
away.
could interrupt, so I'm going to interrupt.
Yep.
So one of the things that we have discovered over the years about the traditional IRA, everybody says, oh, you'll be in a lower tax bracket. It's not true at all. They're in a higher tax bracket because they need more money because they couldn't keep up with inflation. And when we've been at the 7.5, which for several years and now it's still there, um, they're not in a lower tax bracket. So why would you say that anybody even stays in a traditional IRA when they need to get into a lower tax bracket and they need all the money that is making to be tax-free so they could be more like Jay Gould and the Roosevelts and Rockefellers, the robber barons?
That's right. And because you're relying on a lot of people, most of us rely upon income, we get income taxed. And so this comes out of these accounts as income. And in the case of the tax deferred, yeah, the original thinking was is that you'd be in a lower tax bracket, but I'm going to hit 70 this year, and I don't plan on slowing down at all. So
Exactly.
yeah, so you have to plan, and that's why we're such big proponents of the Roth. As I said, you pay for the seed, you get to keep the crop. Plus, you're not required to take those funds out. In both types of accounts, you can't take anything out until you're 59 and a half without incurring a penalty. But once you hit 73, and that will go up to 75 in 2033, for the traditional or the tax deferred, you're required to remove a certain portion of that so that the government can collect its toll. In the Roth, you don't have to do anything. You can leave it in there, or you can, the day you turn 59 and a half, you can empty the whole account and there won't be a penny in tax. Go buy an island somewhere.
But if you
So,
have 401K with your company, you can't take your money out. Can you roll it into a Roth with that company and pay the taxes in the year it earns? Because here's the problem of a traditional is whatever it earns is also taxable. So you deferred your taxes on your income, but now you're deferring taxes on what it earns, and you end up in a higher tax bracket because of that. And aren't there some rules that have been set up so people could start rolling that money to protect them? Because
yes,
we know, yeah, we know lots of people that have like $1 million and they thought it was tax-free. And that's their
yeah,
retirement. It's not the government's
it's
retirement.
true.
Sorry.
It's true.
It
But
that drives
you'll
me
want to,
crazy.
yeah, you want to take advantage of both types of accounts. If you get into the Roth, get into the Roth, get as much into the Roth as possible. But that doesn't mean that the tax deferred is necessarily a bad deal, because your earnings and your wealth will accumulate tax deferred. If you're being taxed every year on what you were making on that capital gains or income, you'd have a much smaller pile to work with. So this accelerates the ability to accumulate wealth.
How do you have a smaller pile? What's
Well,
smaller?
if you're, I'm going to show you a slide here in just a second, which shows you
Okay.
what happens to
'Cause
investments
I'm doubling
outside
my
of the
money
plan.
every 5 to 7 years. And if I'm doing that in my 401, I don't know how that's helping.
All right. If you're taxed every year, and you're taxed on capital gains and you're taxed on income every year for
Mhm.
investments, all right. In the tax deferred, if you're getting a 10% return, you're being taxed on that each year in the non-IRA account or in the non-IRA money. The IRA money, that's allowed to accumulate and to continue to get. So your 10% gain is on a larger sum of money. than would be the case.
But I have
outside
I
of-
have write-offs that allow me to roll that into a Roth and not pay taxes, or maybe a smaller amount of taxes.
Yeah, I'm comparing the tax deferred to not having it in any kind of IRA because you'll pay tax to move it from the tax deferred to the tax free.
Right, but you're paying in the year that you're earning it, which
Yeah.
makes you at a lower bracket
Well,
than
it
it would
depends.
if you wait until you're 70 to start taking money out. And now you're taking out 40, 50, or if you have to take out whatever the percentage is on $1 million, you're in a super high bracket, paying the highest amount. We're talking to people all the time about this, and they are getting hurt with their traditional IRAs, because the opportunity to roll it into a 401k, one, they didn't know they could, and two, they're in a 401 with the company and they have no control over that.
Well, we're kind of mixing apples and oranges here because you don't roll over IRA money into a 401k.
No, the other way.
Yeah. And that would only be after you've left the employment. And there are some rules with regard to that as well.
Well,
But
can
let
people
me,
ask can they ask their company to set up a Roth in the company for the
some
four?
companies offer a Roth component to the
Hmm.
401k. Not all companies do it, but some companies will allow that. And that makes sure when takes time to, when it comes time rather, to move your money away from your 401k, it makes moving your funds into the Roth a little bit easier. But we'll do a comparison here and I'll show
Okay.
you.
Hey, yeah, just wanted to ask you a question. This is
Shoot.
Marcy. Um, you say your people want to withdraw some money. They need some money for some reason or other. Are they business people? Do they have a business? What do they want the money for in particular? Because there is a way to use your monies from your 401k plan. If you put it into a business, it's a whole setup. It's a bit of a rigmarole, but once it's set up, you can take the money out and you're not paying any withdrawal fees, and you're not paying any other kinds of fees because you're using that money for another purpose, putting it into a business.
Some 401k plans allow you to borrow money, and that I believe is what you're referring
It's
to.
not really borrowing. You're using that money for a different purpose, and it's been done for years. And if your business is successful and you want to put the money from your business back into your 401k plan, you can do that. If you choose not to, you don't have to. It's quite flexible.
Yeah, when you set up your 401k, you can enable certain provisions, like you can enable the ability to take money out of the 401k
Joe,
altogether.
can you turn up your sound because you're coming in very low and Peggy's sound is coming out very strong. So
And
Okay.
so are you.
that's why I know it's not my system.
All right. How's that?
It's a
No.
little better, thank you.
All right. All right.
Yeah, so do you do 401ks?
Yes, we do.
Okay,
Yes, we do.
good.
I have one here too, and I allow myself to borrow money from my 401k, which is what that provision is. And you can also allow a participant in the plan to take money out of the 401k altogether, provided they take it into another qualified plan, which would mean there will be no taxes. If they don't, then it's considered a distribution and it is taxable. And if you're under 59 and a half, there will be a penalty. But yeah, those provisions are set up when you create your 401k. I've had one for years here. And again, I set up the provision so that I can borrow it from time to time. And again, the idea is you go out, you do a different deal, you make your money, you repay, and you're back where you left off. So it's a great provision. If you're going to set up your own plan on top of a business you own, that's something you might consider allowing.
Good.
Okay.
Yeah, so people could get a hold of you for that also. That's
Oh,
important.
absolutely. Yeah.
Okay, yeah.
Yeah. We've got solo plans, and we also have plans that would enable you to, to register or have employees participate. So, yeah, pretty much start to finish.
Oh, that's good. That
Yeah.
might be a good thing to talk about at some point.
Um, I could go through each one of these things, but the list of things you can't invest in is a lot shorter than this. And really, it's a matter of almost imagination. With regard to real estate, virtually every type of real estate, we're seeing a lot of foreign real estate now coming into IRAs and 401Ks.
Mm.
So land, raw land banking. Uh, I'm in a fund that prepares land for single family home construction. I'm in another one that buys the land out from underneath of industrial operations so that those industrial operations can recapitalize or can allow the founders to exit. And then that fund becomes landlord for those enterprises. And so it's really any form of real estate is doable inside of an IRA or 401k. Allied to that are the mortgages. I do mortgages and promissory notes. I lend money to enterprises, to fix and flip guys, and I buy and sell mortgage notes. And of course, you can have unsecured notes as well. I have a colleague of mine I've known for many years, and his business requires upfront financing to acquire business. And I loan him money for that purpose, and he pays that back. And I do it out of my IRA. There's virtually every type of structure that except for S corps we see come in here: limited partnerships, joint ventures, investment clubs, registered offerings of the Regulation D and Regulation A categories. And then there are the precious metals. Oh, in the private placements, by the way, it's not just real estate, but all forms of business ventures. I've got a guy who's got a dump truck in his IRA because he leases that to construction companies. And so it's an income producing asset, not too dissimilar from an apartment. So, again, use your imagination. There are some limitations, and we're going to cover those in just a second. The gold and silver, that's probably our third most popular asset category after real estate and business ventures. And that's gold and silver that we would arrange for you to have at a depository. That's not the kind you can hide under your bed, but it's a great investment. More specifically, again, virtually every type of real estate you can do. Uh, some of these new ADUs, these are the auxiliary units that we used to call the mother-in-law suites that people are building because the zoning allows it. Those are being built and run. We've got people doing glamping, which is the glamorous camping, recreational vehicle parks, you name it. It's virtually any type of real estate you can imagine. And again, mortgages, any kind of debt. Private lending is a huge asset category for us. And the interest rates are quite favorable. When I loan on a fix and flip, I'm getting between 12 and 14%, sometimes more on that money. Again, every kind of structure. Now, there's some things you can't do, and this is it. This is it. Nothing, no fine art, no antique rugs, Persian rugs, or any kind of collectibles or gems or diamonds or anything like that. No numismatics and no booze. And the only gold and silver you're allowed to do is the minted stuff, golden eagles, Chinese pandas, Canadian maple leafs, and cougarans, that sort of thing. Those are all okay. But the numismatics, the Roman coins, and all of the commemorative stuff, that's not allowed.
You could invest in a company that makes booze, right?
Yes, absolutely. Yeah.
And
And
you're
let's
investing in a business, you're not buying alcohol.
right. Let's talk about that for
Okay.
a second because yeah, you can't we don't hold crypto, but you can invest in an LLC that buys and sells and trades crypto and
Okay.
repatriates your profits back. There's a company called Masterworks that enables fractional ownership of fine art. And so you're not buying the piece of art, you're buying a portfolio of fine art by different artists that are bought and sold and traded and auctioned. And so that's a little bit different. So yeah, that sort of arm's length transaction is definitely permitted.
Yeah, and you said something about gold and silver. People buy gold and silver, but you said they can't buy gold and silver. So how are they acquiring when you show
Well,
they were allowed to buy?
you're this
I,
down here, basically any minted, just not the collectible kind. Does that make sense? This
so I
is
can buy coins?
you could buy. Well, typically most of us can afford the coins. The bars are a little bit more expensive. I haven't bought any of those. I'd like to, but yeah, gold and silver eagle, gold and palladium bars, that sort of stuff. The
You can buy
commodity,
you can buy those in your
yes,
account. Okay.
in the IRA, yeah. Now
Okay.
it's got to be held by a depository, and it can be held as part of our company account or held, by itself in a cage with your name on it. But there's different ways of doing that. But yeah, it has to be held in a depository. And once you take delivery of it, it's the equivalent of a distribution, and you'd be, it'd be
Trouble. Yeah.
considered, yeah, it'd be considered income if you were over 59 and a half. If you're under, it's considered a distribution, an early distribution, and you would, there'd be a penalty on that.
Yeah.
So,
I'll let you know when I see some bars available.
yeah, I know. That's how if I were you, I wouldn't let me know. So, all right, there's some people you can and can't do stuff with. All right. And probably the easiest way to dive into this is that everybody here in your linear family, up and down, generally you can't do stuff with. That means loaning them money for their businesses, investing in their businesses, that sort of thing. Same with a spouse. Now, I'll draw a quick distinction to help you see this is that my wife and I invest together in the same asset. Sometimes she's a 50% owner and I'm a 50% owner in that asset, but we're not investing in one another. And that's where the line is drawn. So you can invest alongside of anybody on this chart, just that you can't invest with them or loan them money. My brother just retired. He's been a contractor for 40 years. He specialized in backyard fantasies, pools, decks, spas, kitchens, just unbelievable stuff. And occasionally he'd need capital equipment and was strained for cash, and I would loan him unsecured,
Mhm.
and he would pay that back. My nephews are both in really interesting businesses. One of them is in stainless steel welding for pharmaceutical and the oil field. And he early in his business, he needed plasma welders, and I helped him get financing for that. Um, my other nephew is involved in because Houston and that area of South Texas is a lot like Florida. It's just a gigantic swamp. Every time you build something, you have to manage runoff, and so his company specializes in sculpting the land. And so he spends a good bit of time in a helicopter, looking at these things and surveying them, and that's what he does. So very, very interesting things that you can do with it. All right. So, but there are some limitations. Basically, the idea is you can't invest in things that you own or control. There's no self-dealing. So we get a lot of questions like this. Daughter is going off to college. I want to buy a condo. She'll live in one bedroom. Everybody else will pay the rent. And you can't do that because that's considered self-dealing. Same thing with vacation properties. You can't go down there and spend 2 weeks out of the year in the vacation property. That would be prohibited. A lot of people say, "How is anybody going to know?" And we advise, well, don't test them because if you're bragging about how you've got your vacation property in your IRA to your neighbor next door over barbecue, and you have a falling out with that neighbor, that might be something that could get passed along to the IRS. So basically, it's no self-dealing. If you own a business venture, you can't invest in it. And the reason for that is because they don't want business ventures disadvantaged that are not able to take tax-deferred or tax-free money and get that as sources of funding. And they also didn't want people squandering their retirement savings on crackpot schemes that they've cooked up that they really have no business getting involved with. So there was some there was some madness behind the method behind the madness there. So, all right, I told you a whole lot of stuff about all the things that you can't, some things you can't do, and a whole lot of rules that sound like, well, why the heck would I bother doing this at all? Well, it's really, as Peggy alluded to earlier, it's getting the money to be more passive where your taxes are lower. And this is the secret of the wealthy, is that they don't make income. They earn their income passively, or they borrow against their wealth, so they never earn anything. So your typical W-2 wage earner or 1099 contractor is going to pay all of these taxes that you see here on the $100,000 that he or she makes, and it's going to end up netting out about 60. Now, it depends on where you live. California, New York may be higher, Texas and Florida lower, but long and short of it is you're going to take a haircut. So as you move up the chain, the food chain here, to the passive types of income, well, you don't pay all of these little local, state, and federal things, and there's no Medicare and all the other things that they pull out of your income. So you get to keep a little bit more of it. But when you get into the IRAs, you get to keep all of it. Now, the tax deferred, you will pay tax on the way out the door as you take distributions, but you get to keep all of it. So this is kind of where you want to be. And the reason you want to be in the Roth, which is the dark green bar here, is because this is what happens to the investment. And Peggy, this is what I was referring to earlier, is that
Thank you.
I forget the assumptions behind this, but basically we took $50,000 and we grew it at 7% or 10%, whatever it was. Anyway, the idea is that along the way, if it's not inside of a I've got a, I don't know if you can see that on the screen, but if it's not inside of, if it's a taxable account, you're going to get hit every year. And so having it in a protected account gives it a chance to steamroll a little bit and accumulate wealth faster. And so earning 10% on a bigger pile of money or bigger pot of money than you would have after the same amount of money was taxed if you didn't have it in an IRA. And so at the end of the day, after so many decades, you know, that $50,000 grows, and it's considerable, but it's not nearly what you would get out of it if you had it tucked away in a Roth IRA. So it's a matter of velocity of money in this case. Another way to look at it is take a real estate investment that took place inside of an IRA versus outside of an IRA. All right, so there are two owners here, and each of them bought a $1 million building. They were side by side in someplace in Florida, built the same day or built the same year, identical in every respect, and they buy those buildings. So the owner without his or her building in an IRA will get a depreciation allowance, but will pay tax on the net. Now, I realize there are some deductible costs associated with this, so this model is grossly oversimplified, but for a reason. So each year that the IRA owner owns it, he or she will accumulate more of the income to themselves than will the operator of that building or the owner of that building outside of the IRA. But the real magic, and I'll share these slides. Peggy, I'll send the slides out to you so you guys can get a look at the assumptions here. This is Carl Fisher's assumptions. Again, he's been doing this for decades, and these are fairly standard deductions, depreciation deductions rather. The real magic happens when you sell a property, and let's say the identical sale price happens, but you have to give up some of the depreciation that you took, some of that allowance that you took. Plus, there's a capital gains tax on it as well. And so the owner inside of the IRA, inside of the Roth IRA, gets to keep all of that. So for however many years that person owns it, they're getting that full $100,000. And then when the property's sold, they get to keep the entire proceeds. So that's a fairly substantial advantage. And we see this all the time. I take a lot of private placements, and I take a look at their preferred returns and their equity kickers at the end. And I do this analysis, and typically it's going to be 25 to 30% more money in your hands at the end of the day. So
Did you know that a person could do a 1031 exchange out of their property into a passive position? Because a lot of
Yes.
times they end up paying the taxes because they just don't want to manage anymore. But there's a way that we can help them do that if you're interested.
That is good. And we've got some people, Peggy, let me make a note. I'll share our 1031. We've got some 1031 people that we know. And yes, it's a huge area and it's a great escape hatch, for a lot of property owners.
Yeah, they're still stuck in it forever though.
Yeah, yeah, you kind of it's definitely deferring, It's at the end of the day, it's deferring. So if you've got there are some things that are a little bit different about operating a piece of property inside of an IRA versus outside of an IRA. The typical landlord situation, at least in the early days until you build up a say 100 door or 300 door portfolio, is that you're doing a lot of the work and you're saving yourself a lot of money. All right. So maybe in the early days, you're fixing the toilets and you're handling the minor repairs and doing all sorts of things like that. You have your hands on the property, and a lot of old line landlords just they're much more comfortable with this. When you get it inside of an IRA, the IRA operates like a little business, and everything has to be hands off because it's supposed to be a passive investment. And so your IRA will pay contractors and pay taxes and pay the utilities and handle anything at arm's length that needs to be done to that property. Um, Carl Fisher tells a story about when he goes to see one of his properties, he'd rather have his hands tied with duct tape in case he sees something in that property that he wants to adjust or fix, because technically you can't do anything. The saying is you can pick out the paint color, you can't paint the house. So that's one difference that is a little bit tough for older line landlords to get around. But the advantage is that if you're going to build a portfolio of any significant size, you're going to have a network of contractors and specialists and people that you do business with to take care of these properties anyway. And Carl tells a story about having his eye on a piece of property he knew was going to come up for sale, but missing out on it because he was busy saving himself $25 an hour painting one of his other properties. So, there are pros and cons to both approach, but in the end, if you want to build a significant portfolio, you're going to need to do this anyway. So why not have these properties in an IRA? Now, after telling you all of the rules and the do's and don'ts, and then telling you how much more money you could get out of this by putting your investments in IRAs, the steps to doing this are really much simpler than even this implies. There's really three steps. You open an account, you fund it by moving funds from another IRA or a 401k at another institution into your new account, and then you invest. And we would help you at every step of the way. We have online processes to open the account. We do the transfers initiated from here, and we assist you with doing rollovers that you initiate with your existing custodian. So really, it's just three steps. And there are experts that have been doing asset purchases, particularly real estate closings, here for 20 years. So they're a great resource. I have some things for you since I've been kind of droning on, and I think we're at a point where we want to kind of get close to wrapping up, and that is a lot of people say, well, look, I don't have much money to put in an IRA, or I can't afford to buy the whole building, or I can't afford to make the entire investment myself. And so we published this report, and if you hold your phones up to the screen, this should work. If it doesn't, don't worry, Peggy, I'll send it to you tonight or tomorrow, and everybody can have this. But it's 20 ways to fund a deal. And so with a modest amount of funds, you can make an investment. And probably the simplest way for people who are just, sort of getting into real estate, say, is they've got a modest amount of money, and but family members have IRAs and 401Ks. And wouldn't it be great if you could take a rather sleepy IRA or 401K that someone in your family has and delivering a 10 or a 20% gain for them by doing a fix and flip or doing an investment? So This report's really useful. It's not just for newbies either. It's really a great way to kind of rethink. And we're going to come up with a new one that's called 25 Ways. And we should have that done. I've got to give a presentation on that at the end of the month. We should have that done then.
Well, if you buy this book, you'll have 101 ways.
All right,
You're
good.
laughing. I've been in the exchange world for years and years, and we learned 100 ways to exchange and buy and pay for real estate. And this is the book that's 101 recipes to riches for riches in real estate. And you can always substitute it with a different something other than real estate. And then they can always work with our company that works with sponsors and be completely passive and invest in any kind of commercial real estate. So not just trying to find people, but there's people like me out here that have properties that they could, we only deal in commercial real estate, but we always are good at referring. So we want to help you grow with, instead of coming out with 25, come out with 100.
That's great. I'd love to read it, and hopefully we've got some overlap, and maybe there's a few new ones in there for you too. So,
Yeah,
but the
looking
key,
forward.
yeah, the key to finding, I mean, I think everyone on this call is experienced. So, the key to finding deals, people come into self-directed investing and go, great, I've got it. I'm ready. I love it. I love the idea. Now, where do I find deals? Well, you got to get out. You got to network. You got to go to Nest Egg Builder. You have to be part of the community, and you can't just dive in for a social and then walk away with an investment to do. It takes time to build relationships and to learn from people who've made all of the mistakes that you want to avoid. So it's a time commitment. It's a great way to invest, but it's not a magic bullet.
Never is.
Yep. I've got two other things for you. One is that does a better job of explaining this stuff than I did for a half hour. It's 5 minutes long, and it's just a little animated video, and it shows you, how it works and what you can do with it. And then we also have a weekly podcast where we interview people about their journeys as self-directed investors. We have a lot of people who came into this and did a deal. They liked it. They started to understand it. They learned the dynamics of it. Pretty soon they were getting their friends involved in it and investing in groups, and then took the next step and launched funds to do things like buy apartment complexes. And so these are great journeys. They're a lot of fun, and we have a crackerjack podcast host, Michael Duncan, who does a good job on that. That is it. That is it.
Great.
How'd we do for time? We good?
Well, we're almost at the top of the hour, so 20 minutes goes by really fast, huh?
It does.
I did have a couple questions.
Shoot.
Oh, I was just curious about in your company, because you had just mentioned some people get together and invest together. So out of your company, would you say the majority of your people are actually taking their IRA money investing, or would you say that the majority is just letting the money sit doing nothing?
I think there aren't that many people here, but anybody who's been here for any considerable time, and I'm saying over a year or two, is active. That they've caught the bug.
Okay.
Yeah.
And is it because of the education that you offer?
Yeah, I think you marinate in this stuff for a while. I mean, I was an active retail investor. I loved doing the homework and placing my bets, and that's what they really are, on Wall Street. I enjoyed the whole process, and I'd study into the night. And then I met Carl back in the late 2000 aughts, 2008, nine, the monetary crisis, whatever it was. And I didn't quite understand what he did. And then a few years later, he contacted me and said, "Hey, can you want to come over here and help me with some stuff that I'm doing to scale my company?" Because that's what I do. I said, "Sure." And then I hung around it, and man, as soon as it clicked, that this is something I want to do. And so I caught the fever and have been enjoying myself doing this ever since. It's life changing. Um, you know, for anybody who's had the experience of poking along on Wall Street, and market timing is a fool's game, and you're trying to do the right thing and you're trying to invest in the right place and you're frustrated because yeah, you might be making a little money, but you're never gonna get the kind of gains that you see over here on the self-directed side.
Okay, Tina has a question. She said, can you confirm how the property is funded into the IRA? In other
Yeah,
words, I find a property. You understand the question?
I think I do.
Okay.
It's how does an investment actually get made? Your IRA actually becomes, if you're buying property directly, the owner of that property. So it operates like a little business. And so you'll create an IRA and you may even create an LLC into which you would place this property for liability purposes, the same way people do outside of an IRA. And so you would fund your IRA would make the purchase, your IRA would be the buyer. Um, you would be virtually across the table from the seller and with us and the title company involved to bless the paperwork and get all that stuff taken care of. And then your IRA would be the owner of record for that piece of property. Now you may have a
It's
you
on the
may
title.
you may have borrowed money with the IRA to do it, but your IRA is the owner of record, just as you may be the owner of record of your home.
I don't
Is that
think that answered the question.
Well, I'm the owner of the record, but is the IRA the title? Is on the title of the home? Is that what you're
Yeah.
saying?
Yes,
Okay.
it would be.
Oh,
Yeah, the formal name of your IRA would own the property, and the name of it here would be Gamma Plan for the benefit of your name IRA.
Okay.
And if you had tenants, they'd make out their checks to Gamma Plan FBO for benefit of your name and IRA.
Okay.
and then that would be mailed directly to the IRA company. Now,
Yes,
if you were gonna
Okay.
invest with somebody else, you were gonna go into, let's say, into a multifamily, a 300 unit multifamily, it would be the same thing. It just, you would not be recorded on title because you would be inside the LLC as a partner.
exactly. Exactly. You would be your
Yeah.
IRA would be investing in the LLC. You would own shares or units or a percentage, however, the documents recording your ownership are drawn up.
And it would show the same thing. The name of, it would show Kama with your name, FBO, your name, in the name of the LLC.
Yes.
Okay. Let me make sure that. Okay. When you're ready, let me make sure I understand. So the owner would be Kama, and then I would be one of the
No,
partners.
the owner is not
You would
Kama.
be
Kama.
the owner. It's Gamma Plan is
Oh,
just the recorder of the investment
oh, okay.
on your behalf. Your IRA would own it outright. We
I.
don't Yeah,
Okay.
we don't, there's very little cash here in the sense that this is the investments. People come here, they open up accounts, they fund the accounts, and then they make
Right.
investments. And so the money is with the investment. And so your IRA
Okay.
owns that property, and we don't have any ownership take or share or anything.
They are the trustee.
Right.
So basically, you would have two IRAs. You have your standard IRA that you have, preferably a Roth IRA, and then you would have this property IRA
No,
attached,
it's all in the same account.
Yeah. It
all
would,
within the same account.
yeah, you would have it. And this is
Okay.
the way it would work is you would set up a Roth IRA. And so you fund
Okay.
that IRA. And let's say you have a certain amount of money you want to buy, a rental property, and you would buy that. That would be in your IRA. And let's say you
Right.
can take a little bit more money, invest it in a business venture. That would be owned by your IRA. And the titling on all of those documents would be Gamma Plan FBO, your name and your account number. And so when
In the name of the IRA.
yeah, a name of your IRA,
Gamma.
and that's the name of your IRA. If formally speaking, from the IRS's standpoint, that's the name of your IRA.
And then you have reports every quarter. You'll be able to look anytime at your account, and you'll see in your account you have so much money in LLCs, you have so much money in cash, you have so much money in, if it's separate properties that are owned by title, it'll show each separate thing.
Yeah, just like your brokerage account when you log on and you see shares of Nvidia
Right.
and mutual funds and Fidelity, Magellan, it'll be the same thing, and you'll see the value of the investment. Now, one of the interesting things is because so many of these investments pay cash back to you, whether it's in the form of rent collected, or it's in the form of interest payments on loans, or payments and return on investment, that all comes back into your account. And so you'll see a cash portion of your account grow as your investments pay you. And so what I do with my account is, as that cash balance grows, I look for another investment because I can put that money to work. And so I'm leveraging, on out. And as soon as I get to I have my little target amount that I'm comfortable investing in. As soon as I get there, I've already got an investment that I've been looking at. I've done my due diligence and I'm ready to go.
Hey, Joe, can I ask you a question? I don't know how to raise my hand on this thing. I was trying, but I was pinning myself. But can I ask you a question?
Of
Go right
course.
ahead.
Hey, so Camaplan. Okay, so how is Camaplan different from any of the other trustees? Like, are there more vehicles that Camaplan can fund through an IRA than others? I mean, is that what makes you specialized? I mean, what's the difference between Camaplan and some other trustee where can you do the same thing through someone else?
We all play by the same rules, and generally people that offer investment opportunities are agnostic when it comes to the custodian, because they don't care. They really prefer that you work with someone that's easy to work with, because it can be, people do get lost in the maze sometimes trying to do IRA investments. And if you have a custodian that's not paying attention to the customers and to where they are in the process of investing, people can get lost and can get frustrated. So the main difference we think is the amount of service. Can you get somebody on the phone? Because it's not a familiar type of process for most people. It's new, and until you've done it a couple times, it can be a little bewildering. But if you can get somebody on the phone who can help you out and keep you moving through the process, that I think is probably the biggest differentiator. That's the biggest complaint we hear with people who are refugees from other custodians. And look, we know most of the guys in this business. A lot of them got started at the same time as we do. Everyone tries to do a good job. We see them at the conventions, and we see them around, and everybody tries to do a good job, but we think we're a little bit better at the hand holding. So
Which,
does that answer your
Thank you.
question?
Yes, thanks. Thank you.
Sure.
are there any other questions? Because we are at the top of the hour.
Perfect.
So
Wow.
perfect timing for that. So thank you very much for coming today. We really, really
Thank you.
enjoyed your presentation, and we hope you'll come back again.
Oh, thank you so much. Thank you, everybody. Have a good evening now, okay?
Thank you.
Thanks, Joe.
All right, take care.
Thank you.
Bye-bye.
Bye-bye.